This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engines so that more folks can also discover and engage with all things microcap stocks. We are excited for our upcoming investor conference, the Planet MicroCap Showcase Vegas, in partnership with MicroCapClub. This is being held on April 22 through 24, 2025 at the Paris Hotel and Casino in Las Vegas. We have started to market some of the initial presenting companies that will be in attendance, as well as some speakers, the sponsors. And man, I'm overwhelmed with the enthusiasm and everyone's excitement for the event, but we're still 2.5 months away. Like, this is just insane. So we got so much fun stuff planned, amazing companies, just an amazing network that's coming down. If you are at all interested, have even a flinting interest, I guess you'd say, in microcap, you got to come. You just got to be here. Join us. This is going to be one of, if not the best microcap conference, the Super Bowl of microcap conferences, and registration's live. And so please visit planetmicrocapshowcase.com to learn more information, and hopefully I'll see you in Vegas. My guest on the show today is Kyle Grieve, host of We Study Billionaires Podcast on the Investors Podcast Network. I've been a fan from afar and had the chance to hang with Kyle at our conference in Vancouver last year. We had a blast and thought we should bring that energy to the podcast. I wanted to learn more about his background and how he got hooked into our microcap world here. We dove deeper into his thoughts on the differences between a quality business and a quality investment, his criteria for an ideal investment, and we close with lessons that he learned and that really came to his mind from his interviews that he's done on the We Host Billionaires podcast. And for full disclosure, we discussed a number of companies during today's podcast. I am not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Kyle Grieve. Kyle, thanks for joining me today. How you doing, man?
Pleasure to be here. Having a great day.
Absolutely. It's great to have you, dude. And listen, this has been a long time coming, because not only we've been mutual fans from afar, we finally got to meet in person in Vancouver last year. That was just beyond fun. I think every time we saw each other, we just ended up cracking jokes for a good half hour. So, I mean, I'm trying not to set everybody up to say that the next hour might be hilarious. It might just be hilarious to us. So, we hope you find some entertainment in that, but it was definitely kismet as soon as we met. So I appreciate you taking the time here, and also congratulations. We were talking before and I was trying to introduce you on, or you hosted this one or that one. And you're like, dude, no, I'm actually on the main We Study Billionaires feed now. So congrats on that too.
Thank you very much. Our time in Vancouver was a lot of fun, and yes, we had lots of good laughs, and I'm sure we're going to have a lot of good laughs here as well.
The best part that I love also, I've followed the Investor Podcast Network forever and all that stuff, and I've obviously Stig, the whole crew, and I don't know them personally, but I feel like I do because I listen to the pod, whatever. And the funniest part is that you see Kyle roll up to our event at a microcap conference, like, hey man, you're host of this large cap, all thing investing type podcast, but here you are at a microcap conference. Like, bro, we're all closet microcap investors here, bro. That's just kind of how it is. But I'd love to get a little bit of your background, where your passion for investing began. I know you told me a little bit in Vancouver, but I thought it was a cool story to share here too.
Yeah, absolutely. So, I have no formal education in finance or pretty much anything to do with investing. So I pretty much arrived here purely based off of my own passion, basically, for learning about the art of investing. So, I ran my own personal training business for a decade. I was a bouncer for about a decade. And then before I got this job with TIP, I was working in I was installing basically incredibly advanced smart home equipment and learning how to do all that and doing a lot of stuff, going in people's houses and also doing stuff just remotely, which was really fun. Kind of introduced me to remote work, which I really like. And so during that time, basically, while I had that job primarily, it's just only been basically since the year 2020 that I really got into stock investing. I will say before that, I was interested in crypto back in 2017. So that's kind of my first foray into buying risk assets. And that was an interesting experience because it was a time where it was really easy to make money. I 4x'd my money in a couple months just because I honestly, I think it was a lot of luck.
You threw a dart that year.
Exactly. It was a very good time to throw a dart. And and then I made all the mistakes that I pretty much talk about all the time, which is, using leverage, going short, using technical analysis. And I lost almost 97% of my money. I lost so much of it, I basically just gave it all up and I was like, screw it. I'm just going to count it as a zero. But, I kept some of it and I had some Bitcoin and some other coins that still exist now and still they've gone up. I mean, it's not enough to make any difference to my life, but it's cool to have. And then, so I basically forgot about it. And 2018 to 2020, just completely forgot about investing, figured it wasn't for me. And then when COVID struck and, the world was shutting down there for a time, I saw the stock market crashed and I thought, oh, well, hey, there's probably gonna be some cheap things in here that hopefully, might show some opportunity into the future. And when I thought I had that thought process, I opened a brokerage account. And then when I got back into investing and trying to learn about it, because I had no idea about it, luckily I found value investing and not going back to technical analysis and all that kind of stuff. So, that basically started me on this journey. I guess going down this rabbit hole now, it's been almost 5 years. And, I just try to consume as much as I possibly could to learn how to be better at it. And throughout that whole journey, I decided that I wanted to share what I learned with other people because I felt that was the best way to learn it myself, is just by sharing it and try to simplify these concepts for other people to consume. And so then I started writing on Twitter, on Substack, and that gained some traction. And I eventually became friends with Clay, my co-host here on We Study Billionaires, through social media, and he brought me onto the community that we have. And after that, Stig apparently listened, and he liked my voice and he liked my energy, and we found out we were a good fit for each other, and here we are today. But even with this job with TIP, I mean, I'm essentially just doing the exact same thing. It's I'm still learning about investing, and I'm explaining it and helping teach it, and hopefully making it entertaining for our audience to listen to. And I continue to learn more. The more I learn, the more I know that I don't know. So it's been a really, really fun journey.
For sure, dude. And I appreciate the whole story there. I mean, look, dude, you're a unicorn, bro. Like, you got your start in this whole investing world in crypto, and then went to value investing. That you never hear anybody doing that, right? Of just, once they start in crypto, they're either, made their money and they're crypto, lifers, like, we don't even look at anything else, or they lost everything and are like, all right, screw this whole investing thing. Like, let me go invest in, like, real estate or something. Well, maybe not real estate, because at that point, usually they've lost everything and, they start from scratch. But I bad jokes all around. I don't mean to offend anybody, but I mean, yeah, like, what gave you that gumption, I guess you'd say, in 2020? You're like, 2 years I took it off after I lost everything, let me give this another crack. I mean, what did you see, or what did you recognize that you were like, hey, I want to give this another go?
Yeah. To your first point there about going the opposite direction, you're completely right. I mean, most people go from, investing into stocks into crypto, and then they stay there. And, but for me, I think I realized that what I did with crypto was a large outcome due to luck. And so because of that, I figured, okay, I don't really know what I'm doing here. I may as well start from scratch. And so, I was lucky. When I restarted, I didn't have a ton of money. I had a couple registered accounts with a little bit of money in it, but it wasn't that much. It wasn't, it was enough. It was enough money that if I lost it, it wouldn't make too big of a difference. I've never had a zero in investing in stocks. So, knock on wood there. So I mean, with the whole value investing thing, I was trying to find, investments that were safe. And I think that, as I've gotten more and more experience in investing, it's not my point of emphasis is definitely on making sure that the bets that I make can't go to zero, and that's really, really important. I think when I was in crypto, it was all about just what's the possible upside. In a bull market, that's what most people think about, and unfortunately, that's the way bull markets go. But the problem with that is when everyone is thinking that way is actually when it's actually the most dangerous to be invested in, and you have to think about what the possible downsides are. So, in terms of what you were talking about with gumption, I don't know. I think part of my personality is I'm willing to take kind of calculated risks. Kind of like a good example of this outside of the world of investing is jujitsu, where I love jujitsu. I just got my black belt last year, and so even when I roll, I used to compete. I don't compete now, but even when I roll with whoever, I like to just go for things or put myself in really, really bad situations to try to learn how to get out of them. And so, that's kind of been part of my persona for a long period of time. And so I think that that's instilled my ability to try new things in the world of investing. Now, it's been multiple years and I've saved a lot more money. So I have a lot more capital here that I'm using, and it becomes more and more important that I don't lose it. So, I think that's, probably not the best answer, but I think that's part of the reason why I felt that I could succeed in investing in stocks.
Oh, that was a great answer. What are you talking about? No, and also it makes a lot of sense too. You're just like, look, at the end of the day, I know where you recognize your mistakes. It sounds like you recognize your mistakes and, had some time to really think about it. And we're like, all right, okay, if I were to do this again, how would I do it differently? And that's not to say you might not go back to crypto. It was more like, but it's more of a philosophy. You're like, all right, whether it's crypto, stocks, whatever it is, I just want to make sure that I'm doing even more work or more due diligence so that I have that greater level of comfort. I'm not just making, kind of, again, we joke, throwing the dart, but I mean, at that time, especially in the bull market, it was mostly throwing the dart, no matter what kind of research you did, so it seems like that's really what your philosophy became. I mean, how would you say that that's evolved even since 2020, where, I mean, I'm sure you will always have that foundation of, safety, calculated bets, calculated risk, but how would you say that philosophy has evolved since then?
Yeah, I think one just kind of super usable thing that I've started doing pretty much since 2023 is using Bayes' theorem. And I don't want to get into mathematics here and bore your audience, but essentially what it is. Are you
kidding me? We're all nerds here. Math out. Let's go. We can math out.
Well, yeah. So with Bayes' theorem,
here I need to.
Obviously,
I'll go like on A Beautiful Mind. I wish I had the window and just do something like that.
Absolutely.
Sorry. Last joke on mathing out. Go.
I'm definitely not nearly as smart as what was his name in The Beautiful Mind?
Nash.
That's right. Yes, yeah. Nash. Nowhere near as brilliant as he is. But anyways, luckily with something like Bayes' theorem, I used to use different probabilities for different outcomes, and I think one of the big changes I've done is just like really, really punishing myself on the downside, and that just obviously decreases the value of a business into the future. But that's okay with me because, like I just said, I like to really emphasize the downside. So that's something that I've really been working on over the last year, and trying to make it harder for a business to pass my barriers, and kind of getting to microcaps here. I like a lot of these inflection type businesses, and it was interesting when I first got into them. I'm like, I kind of succumbed to the common investor biases that thought that a lot of these microcaps are crappy businesses, and sometimes they have these monster runs up and then they just disappear or go to zero or whatever. And while that is true to some degree, that's also true with bigger businesses as well. But nonetheless, you still have to really pay attention to it. And so with a lot of the nano caps, I really focus on future earning streams more so than these kind of like more value investor based asset plays. That's a principle that I've actually kind of thought about to myself, because when I look for businesses that I'm like, oh, the sum of the parts is worth 3 times the current market cap, but but earnings don't grow at all. I've done a couple of those, and they always are utter failures for me. So I've kind of figured out like I'm not good at that. I'm way better at finding businesses where they're just going to grow their earnings, hopefully into the future. Over with my small caps, I'm looking pretty short term. It's a year, 2 years. If they can keep doing it longer, wonderful. I would love for that to happen. And so I think with that, the part of the draw for me with microcap businesses is just that no one's looking at them, and so you don't get a lot of professional analysts looking at it, covering business, and driving the prices up. You get businesses that can grow at 30, 40, 50, 100%, top and bottom line, and they trade in single digit multiples, and you don't get that in large caps, because they have an army of analysts who are really intelligent and getting paid a lot of money to look at these businesses. So that's part of it. So and then the still the largest part of my portfolio is in quality businesses, and I still make that the priority. But and then with those, I think, in terms of the downside, a lot of it's just in the quality of the business. Just, I'm hoping to find businesses that are of such high quality that, any downside is going to be protected by the quality of the business, hopefully protecting it from, the vicissitudes of capitalism. So, yeah, I think that's a good kind of reasoning as to some of my evolution lately.
Absolutely. So when did you get your first exposure to microcap? Look, I know you're Canadian. By the way, thank you. We're recording this on Thursday, February 6th, so I appreciate, us still hanging on here for our scheduled time of recording. I still love you guys, a lot of many friends, glad we came to a 30-day pause. Anyways, enough stupidness on that. But, I know you're Canadian as well. The microcap ecosystem, I always like to say, in Canada is either the best in the world or in the top in the world, because it's just very high quality for all the many reasons you can hear, all the many shows I've done talking about that. But where did you get your first exposure to microcap? Do you feel like it's because you live up there, there's a lot more, there are some smaller cap names that are more in your purview, or did you happen to find it somewhere else or get exposed to it somewhere else?
Yeah, that's a tough question. So I guess my first microcap was in 2023, and that was just from honestly learning from people on Twitter. I mean, because I'm in Canada, of course, I have a bias towards Canadian businesses because I understand them a little bit better. Like if I want to go visit them or talk to people who are involved, it's just easier for me. And of course, I want to support my country as well.
Your non-resource side of your country.
Yes, that's right. Yeah, the non-mining side for sure. But so I think I kind of just the first one I found was just like I said, through Twitter, and then I interviewed Paul Andriola, who I'm sure I think for sure you've had him probably multiple times on this show, so everyone's probably going to be familiar with him. And when I was researching for that first interview, which was actually my very first interview on podcast, it was just really eye-opening, just learning all the stuff that he'd written and he talked about, and it was almost like unbelievable how cheap some of these names were, and how fast they could multi-bag, and it just because multi-baggers kind of feel like this kind of like impossible thing to find for most people, and I think that goes past just the ability for a stock to go up consistently over time. It's just also the problem with investors being like, okay, my stock's doubled, let's sell it. And that's probably not a good way to invest, but I won't get into that right now. That once I started talking with Paul and learning about him, we kind of developed this friendship. He's also in Vancouver, so we meet up, we've met up multiple times and just talked on over coffee, and he's taught me a lot and helped me understand the landscape of microcaps a lot better. So I'm lucky to have that edge. But I mean,
pretty awesome edge. Paul's one of the best.
It is a very good edge. Yes,
how big of a fan I am of Paul and Trevor and the whole crew up there. So
absolutely, and Trevor's awesome too. Trevor, I've developed a bit of a friendship with him. We've gotten a chance to talk a few times, and if I want to ask him about some due diligence on a small cap, he's always there with incredibly good information. So small cap, those guys are awesome.
They read the CDR Plus filings so that we don't have to.
There you go.
they get after it on CDR for sure.
Yeah, exactly. So, I guess I kind of, it was a mixture of organically finding it and also finding it through Paul, and also obviously through Ian. I followed Ian for a long time as well. So yeah, and same with Ian. I've talked with Ian a bunch of times, and he's such an intelligent person and great resource, and I love learning about his experiences. That, you know, from going to being just basically a retail investor to being a full-time investor to now managing a fund. It's a pretty cool journey to follow along with him, and he's just a great guy, and he's great for the investing community.
Heck yeah. No, hey, listen, I couldn't agree more.
Just like you.
I'll listen. I'm just a microphone man. That's it. You know, I'm just trying to make sure, you know, it was funny when I think about, you know, the podcast, you know, we're coming up on 10 years and doing the show now, right? And which is kind of wild. You know, Ian was my first interview on the show back in July 2015, had Paul on a few times. It's pretty cool to see how, you know, quite a few of these folks have grown and evolved and, you know, are getting the recognition that they deserve, you know, not just as people because they're awesome people, but for just being great investors, you know, and doing the work and people recognizing, you know, we're going to continue to, you know, try and amplify that because we should, you know, I mean, you're doing the same thing over a tip. And it's just really cool to see now, like, you know, my old age here of 36 and the crusty old vet and seeing all this, but it's pretty awesome. I mean, some of these guys I had on back in 2018, you know, were either just starting their funds and now they're just full on small cap. They don't even bother with microcaps anymore because they've done so well. I mean, it's pretty wild to see. You know?
Yeah, I agree. It's pretty fun to watch some of these guys just go through years and just crush it. I enjoy watching, and there's a lot of cool characters in microcaps that you can follow that have incredibly good track records, and you just don't hear about them because either they don't want to share them because they're not looking to raise capital, or you know, they don't want to have the wider
audience. Yeah, or the wider audience here's microcap. Yeah, okay, for sure. Like, leave those freaks alone over there. You know, but cool. Exactly. Yeah, no, we will happily be freaks over here by ourselves. And, you know, you want to dip your toe in the pond? By all means, join us. It's fun over here.
Absolutely. Once you try it, you're probably not going to go back.
That's kind of it. You're just stuck. So Kyle, next question I have for you here, you know, kind of going through your philosophy, growth to, you know, where you're currently at today and whatnot, you know, now I'd love, and you kind of alluded to this a little bit, but I'd like to hear from you, you know, specifically, what does that ideal investment then look like for you right now? What's that criteria when you're opening up a new idea that, you know, maybe you found on Twitter or elsewhere, or whatever, you know, what are some of the things that you're looking for your checklist?
Yeah. So, I think about this a lot actually. So, you know, when I looked at Buffett, yeah, perfect. Exactly. Perfect. When I researched, a lot of Buffett's early days, that's actually what I find most interesting, because I think I personally can resonate a lot more with his early days versus what he's doing now. You know, what he's doing now, he has this incredibly tiny universe of stocks that he can actually invest in. But if you go back and look at what he was doing when he first started, he was a microcap investor. It's all he invested in was these tiny illiquid microcaps that nobody knew about, and there was no internet. So, you know, he had a even bigger advantage, you know, than probably what we would have today. And so one of the things that I really liked is, you know, when he was in his early days, he had these different segments of his portfolio. You know, he had his workouts, turnarounds, takeovers, and his generals, which were kind of his biggest, or one of his biggest areas. And so I've kind of taken a somewhat similar approach. So I kind of have two just areas that I think of. So I have my quality businesses, and then I have my inflection point businesses. So pretty much all the small cap businesses go into that inflection point category, although some of them do, I think, end up in maybe like a hybrid between the two, or are, I think, pretty quality businesses. So, I mean, what I look for in both is reasonably similar. I want businesses that hopefully have high insider ownership, you know, long reinvestment abilities into the future, high returns on invested capital, and, you know, obviously have really, really good management on top of that insider ownership. And so when I look at some of the, you know, more the quality businesses, they generally have obviously a longer time of being an excellent quality business, meaning that they might have, you know, 5 to 10 years of being profitable or cash flow positive, et cetera. Whereas with inflection point businesses, I pretty much just cloned Paul there. I'm looking for, you know, 2 quarters of of profitability, which is obviously a much shorter period of time. So kind of just talking to portfolio management stuff, generally speaking, my quality businesses, I'm more willing to put more money into just because at my core, I'm lazy in terms of investing. I like to just own something and then not have to really pay too much attention to it. And microcap investing is the complete opposite of that. So I kind of like it. I just like having two areas. And so, some of my businesses, my higher quality businesses like a Topicus or Lumine, which are, obviously these Constellation spinouts. They're these businesses they're just really easy to own. They always do well. It's crazy, but that's just the way they are. And I basically don't have to worry about it. I don't have to, obviously I keep very close track of them, but I don't even really have to if I didn't want to. Whereas with the inflection point businesses, I'm on them very, very closely. I pretty much pay attention to what they're doing on a as often as possible. So, it's that kind of, those two buckets are kind of, what I look for. But even with the nano caps, I'm still looking for exact same thing: good quality management, high returns on invested capital, hopefully a long runway. But I do realize, with a lot of these inflection point businesses, and speaking to Ian's point that most businesses deserve to be rented and not owned permanently. So I definitely incorporate that a lot into my thinking. And so when I first started investing, I had this thought process that followed Buffett that was, look for business that you can own forever. But that ended up really crushing me because I made mistakes, and owning a business forever only works if you have like the perfect business that can continue compounding at really long periods of time for decades. And then also doesn't get insanely expensive or, get bought out. I mean, it's rare. It's very rare to have those types of businesses. So, what I've noticed now is just, I have to be a little bit more harsher on letting businesses go. And that's been a huge learning for me pretty much since 2023.
It's interesting you bring that up because that's a point we've talked about a lot on here. And many folks have said like that's part of the strategy and still continue to employ that. And whatever works for everybody, it does work. But it's interesting to kind of critique it a little bit in the sense that it almost limits you in some sense, especially when you're a small microcap investor. Because, you want to talk about a tiny universe of companies that even fit into that bill of something that you would want to own forever. Like, really think about that. Like, that's such a limiting factor in many respects for a lot of these businesses because for many reasons. Is that something that you thought about too when you were like, I'm having fun looking at all these different businesses and, there's a lot of good quality aspects and factors to some of them. But if I'm having the mentality that, I want a business that I can own forever, which can work, don't get me wrong, and you can find them, it's also limiting me from maybe some upside in some of these names.
Yeah, I completely agree with you. I think what I kind of ended up moving towards at one point was just looking for high quality businesses. And I still, like I said, I still love high quality businesses and I'm willing to pay up for them. And they've actually worked out quite well for me when I've gotten the quality right. But what one thing I really have been focusing on more is there's quality businesses and then there's quality investments, and a quality investment doesn't necessarily have to be a quality business. And so that's been really, really strong learning for me because, at the end of the day, yes, I would love to have quality businesses and I always try to look for some point of quality in all the businesses I own. But, there's also businesses that might not have the same quality as another business that I own, but the risk adjusted upside is higher. Right. And so that's kind of what I found in these inflection point businesses is that, the quality, if I look at all my inflection point businesses, nothing touches Topicus or Lumine or, like a TerraVest. And that's perfectly fine because, these inflection point businesses are also trading at like a sixth of the multiple or even less sometimes of some of these businesses. So you get this margin of safety and you get a really, really good upside that can happen. And, but yeah, so I do think it can be a limiting factor for sure. I think one thing that I spent some time thinking about is how just retail investors, a lot of them seem to want to follow a lot of these giant hedge funds. And in my head, I'm just like, why? Like these giant hedge funds, for one thing, they have to invest in large businesses. They have all sorts of basically handicaps due to the regulations that they go through to do with market cap size. They all have to try to beat the index on a quarterly basis. And it's just like, that doesn't resonate with being a long-term investor. And so, for me, I mean, can you learn from them? Of course you can. These guys are incredibly knowledgeable. That's why they're doing what they're doing. But, I think you got to pick and choose the parts and areas that you want to learn from them. And there's a lot of stuff that you can just ignore, like, following people, a hedge fund manager who has 100 positions. And if they're, adding or subtracting a position, like, it's just not that big of a signal to me. And then on top of that, even in the quality businesses that I do own, I still look for small businesses. Like my biggest business is $10 billion in market cap. So, a lot of these larger hedge funds is just, in terms of getting ideas for actual stocks isn't that interesting to me. It's more of the strategic and portfolio management stuff that I like learning. And they sometimes have some interesting takes on the macro environment and stuff like that. But I think I was probably going off tangent there, but I hope that was valuable.
No, it definitely was. One quick counter, I don't know if it's a counter or just or reply to because this is something we always we've talked about ad nauseum is, me and you, we'll talk till we're blue in the face. Like, if you're retail, you should be looking at microcaps. Like, this is where, the greatest of the greats have, made their, you said it yourself, Buffett, they're all microcap investors. They all say they wish they were still microcap investors, right? And yet still, a lot of retail will still follow kind of the larger hedge funds, see what they're investing in, all that kind of stuff, for various different reasons. But at the end of the day, as much as we talk about the opportunity and how, till we're blue in the face, you got to be willing to do the work, and be I've lost my largest losses have always been investing in other people's conviction and not doing the work myself, and that right there would, I think that would really cause a lot of people, if they did it like that, and a number of people do, they lose. They're like, I'm never doing microcap again. Like, I thought that guy was smart. And what a moron, It's like, even if they did good work, it's like, you're just checking the stock every 2 minutes, right?
Right.
So, that's the one thing. But, I do feel like the tide is changing a little bit, where people are wanting to understand smaller businesses a little bit better. Maybe that's just, maybe wishful thinking. I don't know. I don't have any actual real concrete evidence of that, but it could be changing, it could not be, but we'll table that for another day. The main thing I really want to follow up on, because I thought this was super interesting, and it sounds like you're jamming on it super hard right now, is the idea of a quality business versus quality investment. I mean, if you'd be willing to, love to hear maybe an example or that you're currently working on or past position, something. I mean, you don't even have to name the name of the company, but love to hear an example of one where it was like, all right, this was either quality business, love to hear you dive deeper into that.
Yeah, sure. So full disclosure, I'll talk about a business that I own that probably a lot of people have heard of because they're kicking themselves for not getting that, which is Zcore. Zcore is one I got in early. It's been my best performing business that I've ever owned, actually, and that's one where I actually knew about Zcore for I think it was probably 8 months before I actually bought it. And I just couldn't get over this hurdle about them diluting basically shareholders in order to continue growing. And so I was that part of quality really concerned me because, to me, generally speaking, a quality business, one of the things I didn't add was that a lot of them they can fund their own growth, right? Another business that I own, this Polish seat convenience store, they basically don't take in outside capital. They haven't diluted by one share since they IPO'd. So, things like that, I love that. That's great. But in the micro-cap world, that's incredibly rare to find because these businesses are small, right? And if they want to grow, they don't have the capital and they don't have the relationships with bankers, because a lot of times these bankers don't necessarily want to loan money to a business that's just been profitable for a short period of time and has been unprofitable for the majority of its existence. So, I think that with Zcore, luckily what I got to actually meet with management at SCD event back in 2023, and I talked to them about it, and they seemed to think that they were moving towards a direction where they could, they're probably going to start doing a little bit of they might be able to they're getting a better relationship with banks, and it still hasn't actually came to fruition. And I think part of the reason for that is that they realize that as stock's gone up in price, it actually makes sense to use their stock as currency. And then on top of that, the other thing I really realized was that, if you have a business that's barely growing, if the business is growing at 10%, well then diluting really hurts like badly. But with a business like Zedcore, they're essentially growing at 80 to 100%, and I think that might happen for a few more years into the future here, which is crazy to say, but just given where I think their tower count is heading, that's what I think. And so, as Zedcore, it's definitely not. It doesn't have a lot of the quality attributes that I look for in compared to the quality businesses that I own, which are super low debt. That's basically it. I mean, with them, they're trying to grow at such a fast pace that they can't internally fund, because otherwise they'd have to drastically reduce how fast they're growing. So, and to me, when I looked at Zedcore at first, I was very put off by the points I just made. But then I realized, okay, well, they're getting better relationships with the banks. They're still growing incredibly fast. They're executing at such a high level. That was one of the big reasons why I wanted to get in, was just the execution. It was very impressive. They said how many towers they were going to have. Each of their quarterlies, they would be right on track, and then they would also do an update between, and they'd also be on track. And so I was really impressed with that. And speak with management, it looked like they just were really impressive people, and and it's just an interesting business because they basically just kind of fell into it. It's not like this has been a business that's been around for a long period of time. So, yeah. And then, another point, obviously, with quality businesses I spoke about, that I like looking for businesses that have these, reasonable moats, right? And Zedcore at its face doesn't seem like it really has any type of moat. So that was also a big reason why it took me a long time to kind of wrap my head around what they were doing. And even today, like, I still don't think their mode is particularly amazing. But I think that they're in an industry that's just growing at a very wide pace and hasn't been penetrated, and there's not really a lot of big players in them. So I think there's going to be lots of smaller players just vying position. And even if they take 1% of the market in North America, it's incredibly value accretive to the shareholders and to the business. So that's why I like it. But I stay on top of it all the time and try to see what competitors are doing. And there's definitely competitors in there trying to steal market share, but it doesn't really seem to be stopping them at all lately. So I'm just holding my shares.
Absolutely. That's a great example. So that really was a perfect example of, according to your definition of a quality investment versus the quality business. Have you ever come across an idea where either you actually invested in, or you were just looking at closely, that had all the metrics of a quality business, but you're like, but I don't think this is a quality investment? I'm assuming it's probably because valuation was just probably ridiculous at that point, but correct me if I'm wrong if you have an example of something. Even if
you nailed it.
Yeah. Oh, okay. I did.
Yeah, you completely nailed it. I mean, most of the times there's businesses that I like, and the economics of the business are incredible, and it looks like the type of business that you could probably hold for a long period of time, but the valuation just doesn't make sense to me. I think I've been spending time here on an episode, and I'm researching a lot of Michael Mauboussin, and he has some really good points that resonate with, if you've read Where the Money Is by Adam Cecil, where you look at traditional GAAP numbers and them not necessarily being a true signal of the economics of a business because of accounting standards, right? Like if you look at, a business like Adobe, which is one of the examples in Adam Cecil's book, they spend tons and tons of money on research and development. And so with GAAP, that gets punished. It gets, expensed basically as if it's meaningless. And the point being that, with a lot of these businesses, it's not meaningless. It's very meaningful. And it's essentially, they're just investing into their future, and it should probably go on the balance sheet. So if you make those types of adjustments, sometimes businesses make more sense with what they're actually trading. And I think that there's enough intelligent investors out there that are making those adjustments too. And that's why they drive the prices up. But again, that's probably not something that you're going to see too much in microcaps, just because there's not a lot of people looking at it, and I don't know how many of them would know a lot about the accounting standards. Probably a lot of them do, but yeah, I'm going off on a tangent there. But yeah, so I think, like you said, definitely tons of high quality businesses out there. And I think essentially, if you really want to get in at a really good price, you have to wait for like gigantic market corrections. And when that happens, you just got to deploy a ton of capital. It kind of reminds me of Pulak Prasad, who wrote What I Learned About Investing from Darwin, which was one of the best investing books I've ever read. And so we got the chance to have him on our community, and we asked him about
That's awesome.
how he deploys capital.
I think my dad read that book, or he might still be reading it right now. Yeah,
it's really good. I highly recommend it. Yeah, I did an episode on it. So if you want an intro, check out my episode on it. But yeah, so he has a really interesting thing where essentially he can call on capital whenever there's these giant swings in the market. And so in his book, he makes the point that during almost the entirety of the fund's existence, they haven't deployed any capital, but there's been like these very, very short time spans where the market crashes and he deploys like hundreds of millions of dollars. And that to me is a incredibly intelligent way to invest, but obviously requires a lot of patience, and patience is a big problem in investing, because I think as humans we like to always feel like there's something that we need to do, and that's not necessarily the best trait to have in the world of investing. So yeah, I mean, what I would say is if you're looking for quality investments, you have to be patient. You know, sometimes maybe what I like to do sometimes with some of them is I'll just take a position even if I don't like the price. And that way I know that I got some skin in the game and I'm going to follow along with the business. And whenever there's weaknesses in the share price for whatever reason, whether that's, you know, these tariffs that are going on, or if there's some sort of other market-wide sell-off, then you just add to the position there. That's one of the better strategies that I've come across. You know, there's nothing perfect. But yeah, that seems to be basically one of the few ways to get into these really high quality businesses at a price that actually makes a lot of sense.
Nice. Yeah. Nope. I think that's a really nice strategy. So I'm going to ask a question that I love asking everybody on here, and it's good. I'm going to cater it a little bit to this quality business versus quality investment. That's probably what I'm going to name the pod anyway. You know, what would you say has been an experience, you know, starting from 2020, let's excluding the crypto. I'm sorry to Clay, but we're going to exclude the crypto right now. I'm a fan, by the way, so don't, I make jokes, but what would you say was an experience where you kind of starting to think more about this, like quality business versus quality investment, where you're like, you know what? Yeah, this has, you know, there's a little hair, but it's fitting all the things from a valuation perspective that, you know, I might want to take a large position, that you're just like, man, either you got it not necessarily fully wrong, but maybe didn't see something, didn't expect, you know. Love to hear an experience. You don't have to name the name. If you want to name a name, fine, but if not, you know, all good too.
Yeah, there's one I can name it. I don't own it anymore. It's called Seritage Growth Properties. That's one where I think you're right. It basically, they owned a bunch of old Sears properties, and it was spun out, and you know, essentially, like I was talking about with some of the parts, you know, if you added up the property value, it was worth a lot more than the market cap of the business.
Right, like a liquidation. Yeah.
Yeah, exactly. And it's funny because actually with that one, the outcome for me was actually positive. I ended up profiting on the investment. You know, it didn't go down, but I still actually consider it to be a failure because I felt like I probably didn't understand it nearly as well as I should have. And you know, I guess I felt like it had some of these quality aspects. But I think kind of to your point there, talking about borrowing conviction, I probably borrowed a little bit too much conviction following Monish Pabrai into that one. And other investors as well. But so that's probably one really good example I can think of where I felt like it was a bit of a mistake, even though it was optically a somewhat quality business to me. But yeah.
Absolutely. So I want to shift a little bit to, you know, now your experience on, you know, as being a host of We Study Billionaires, you know, having done the millennial investing podcast before and now getting the bump up there. You know, you've been doing this, what, about a year, 2 years now, you know,
two and a half. Yeah.
And you've gotten to interview some really incredible investors, some incredible people already. What would you say has been some of the main takeaways that you've gotten from some of those conversations that you've been able to apply to your own investing philosophy? I mean, you kind of alluded to quite a few already today. You know, you're pulling the quotes here and there. I've been very impressed. I wish I had a brain like that again to remember all the quotes from people I've interviewed over the years. I used to be able to. Now I can't. It's called having 3 kids. But love to hear some of your thoughts there, and who really had an impact on you, and all that good stuff.
Yes. So, it's interesting because the people that I get to invest or get to interview are, sometimes they're investors and sometimes there's authors of books that I found really impactful. So probably one of my favorite interviews ever was actually Annie Duke, who is not an investor at all, but she was absolutely,
she's awesome,
incredible. Like her content and her books are just next level. So it was such an amazing opportunity.
She's an enigma. I've interviewed her too. She's an enigma, bro.
Totally.
I was sitting there just like, I don't even know what to friggin' ask right now. You were so smart.
Yes. Yeah. She's incredibly smart and thoughtful, and obviously understands how to teach things to people and break down these concepts. And so, a couple, like, the one thing I really learned from her was just about kill criteria. I absolutely love kill criteria. And so kill criteria is essentially just a criteria that allows you to kill a thesis. And so, it has 2 parts, a state and a date. So, so now I do this basically on all my businesses. And so, for instance, there was a business I had where I looked about a year into the future, and I wanted it to have a couple specific quantitative metrics. And the thing with kill criteria, in my opinion, is it has to be kind of quantitative. If you make it qualitative, it's really easy to just torture your either your initial thesis or what you're thinking now to fit where you want it to go, which I think is why it needs to have some quantitative aspect to it. So, there was a business, and I was like, hey, well, I wanted to have this set of numbers. And so earlier this year, they came out and I just looked at it. And even though my deadline was in September of 2025, I'm like, there's like no chance that they're going to hit this, meaning that it's going to be a kill. But luckily for me, I decided, okay, well, I still like the general direction of the business. So I just reduced the position size because it was one of the bigger position sizes, and I just felt like it didn't deserve to be a bigger position size. And I just reallocated that elsewhere. So kill criteria from Annie Duke, and I mean, that was huge, but I mean, there was so much stuff I learned from her. And then there was another investor I spoke to, Vitaly Katzenelson, who wrote this really good book called Soul in the Game. And I love that book because he talked
awesome people, dude.
Yes, absolutely.
Vitaly's
absolutely
amazing. I'm a subscriber to his newsletter. I love reading.
Yes, me too. Excellent newsletter.
Just
and so thoughtful. He's so thoughtful, such an intelligent person. And so in his book, he had it was split over 3 chapters. And the one chapter that impacted me the most was just 3 segments was his points on stoicism, because to me, stoicism was always this kind of this, spiritual way of looking at the world. But when you read the source material, it was really hard to kind of make sense and make it coherent to actually use it in a daily basis. And I actually really liked what he did, because he broke down a lot of these principles and showed you, dichotomy of control, for instance, or that was one area that I felt was really interesting, which is simply that, there's some things you can control and there's some things you can't. And if you live your life understanding that, you're just going to be a lot happier and probably have a lot more joy, because you won't worry about the things you can't control, which is a lot of things. And, in the world of investing, of course, I mean, there's so many things that we can't control. And I think that a lot of the reasons that investors make mistakes is that they focus on all these things they can't control, and they try to, estimate or forecast these things again that no one can control, and they make decisions based off that. And so, for me, I feel like you can, if you focus on that dichotomy of control and focus on what you can control, you can focus on what's in your portfolio. You could focus on specifically how your businesses are doing. But things like the macroeconomic environment, I have no idea. I have no idea what's going to happen with interest rates. I have no idea what's going to happen with geopolitics. And there's people with PhDs, and it's been shown that they also can't estimate these things. So what chance do I have? So that's why I really like talking with him and learning more about stoicism. We talked all about a whole bunch of different stoic tools. And so, yeah, those 2 people had huge impacts on me. And then, so there was one investor I spoke to in 2024, Scott Barbie, and he was awesome. Like he's another person who's very hardly anyone knows about him, but he's just been beating the market for like over 25 years. And he's interesting because he's kind of on the exact opposite end of how I invest, where he's just looking for businesses that are ridiculously cheap by, price to book, trading under book. And that's obviously, for me, that's an area that I feel like I don't succeed in at all. So I love learning from people who can succeed in that. And he was great just because he's been around a long time. I got a chance to talk with him about how he dealt with the great financial crisis. I think his fund went down about 74% during that time. And I mean, man, I cannot imagine how painful that must have been for him. I could tell when I was talking to him how painful it was. But then, he also he basically played the whole thing flawlessly. And so he told me I think it was either 2008 or 2009 when the market started rebounding, his fund went up 91% and he made the cover of the Wall Street Journal. So everyone thought he was he was this unintelligent investor who was getting killed. And then he made it onto the Wall Street Journal. And he told me, he's like, I don't think I really did that much. I essentially just held on to my businesses, and I could tell that, yes, my businesses were getting pummeled in share price, but the businesses weren't any worse. It was just multiple compression. He's like, so I just waited and the multiples just went back up, and there you go. Just progression to the mean. So I really enjoyed Scott Barbie, but I mean, man, I've learned from so many of my people that I've interviewed. It's hard to nail a couple things down, but those are a couple things that come to my mind now.
Those are some really good ones, man. And specifically to the Stoicism one, for sure. Like, just, it's funny. It's one of those philosophies that you've always known about, especially if you read, you're kind of aware of certain things going on, philosophy and stuff like that. It's one of those things that you wish you'd applied to your life earlier, right? Like, as I'm getting older, I'm like, oh, Stoicism's the best, just especially with the idea of dichotomy of control, and just how much that really just helps you focus on, getting the main things done, not worrying about whatever, and you kind of let things roll off your back and stuff like that. But, at the same time, you're just like, damn, I wish I embraced that when I was 18 or 16 or something. You're just like, how much more stuff could I have gotten done at that time rather than worrying about this, that, the other thing? Oh, it's so annoying.
Exactly.
But, so, Kyle, I hate to cut us off because I know there's so much more we could kind of get into here, but I'm sure we'll be back to jam on other ideas,
I'd love to.
Philosophy. I mean, that was super fun. So, I mean, to close this out here, what was that one piece of advice that you'd love to give any new microcap investors out there that maybe are starting to, dip the toe and want to learn a little more?
Yeah, no, that's a wonderful question. I think that if you're new to the microcaps, I'm a concentrated investor, but I would actually probably say to not be too concentrated, just because if you're brand new to not only microcap investing, but investing in general, you're going to make these big mistakes, and having a lot of money behind something is probably not the way to go. So, I would probably say to make sure you're a little bit diversified, and as you get more and more experience, then you can start taking bigger position sizes. I think that's a really intelligent way to go. And then, like we both have been talking about here, borrowing conviction. Horrible idea. So if you find a stock that maybe someone that you highly respect really likes, that's great, but don't just go out there and hit the buy button. Use that as a springboard to learn more yourself. So go out and read the documents, go out and try to reach out to management. The beautiful part about a lot of these micro caps is that management will respond to you. And a lot of times the IR department's the CEO of the business. So reach out to them, see if you can learn more. Just the exact same kind of things you do with a bigger cap company. You should try to learn that information. The benefits of bigger companies is that there's tons of analysts, so you just a lot of content to read about. Whereas with a lot of these smaller businesses, it doesn't exist. You have to go out there and find it for yourself.
That's freaking great. Just wish I'd get one of those. Sorry for those not watching the video. I just, we did a virtual hand round right there. But Kyle, this was awesome. Where can folks go and follow you on social media, as well as hear you on We Study Billionaires?
Absolutely. You can go to just theinvestorspodcast.com to listen. You can go on there and look for us. We're on YouTube, Spotify, Apple. And then if you want to follow me, I'm somewhat active, less active than I used to be on Twitter. My handle's irrational MRKTS, and then I'm on LinkedIn under Kyle Grieve as well.
Beautiful. Kyle, absolute pleasure talking to you here today. Good luck, stay safe, and I'll hopefully see you in Vegas.
Thank you. You too. And maybe we'll see.
All right, there we go. All right, take care, man.
No worries.